Welcome back here to Mountain Connections. You know, tax season is surprisingly right around the corner. This year has just gone by so fast. For those of you who are wanting to learn more about ways that you can save on your taxes this year, you're definitely going to want to stay tuned for this next interview. I'm speaking to Sharla Jessop of Smedley Financial here about some year-end tax strategies with your investments. Sharla, how are you doing?
Good. How are you, Diego?
Great, great. Thank you so much for coming on. We really appreciate it. Let's talk first about Smedley. Tell me a little bit and a brief overview about your guys' company.
Our company was founded about 37 years ago, so we've been around quite a while. We're located in Salt Lake City, and we work with individuals and businesses to help them maximize their investments and tax opportunities.
That's excellent. So we're talking specifically about some year-end strategies using investments, and something that we're going to start talking about right now is the idea of tax harvesting. So for those of people who are watching who don't know the strategy, can you break it down for them a little bit?
Sure. So let's say that you have an investment that's grown $10,000 and another investment that's lost $10,000. By selling both of those, you can wipe out any taxes that you would owe.
Wow.
That's tax loss harvesting. The benefit is by doing that, you avoid any capital gains taxes on long-term investments. So if you hold an investment for a year and a day, it's considered long-term. It's taxed at capital gains rate. If you own it for less than a year, it's short-term capital gain or short-term gain, which is taxed at ordinary tax rates, which are higher.
Higher, gotcha.
So the catch is you've got to match your long-term gains and losses and your short-term gains and losses so that they can offset each other. So that
they can offset each other, which is a very smart tactic heading in to the next tax year. And they don't have to match exactly, is that correct? The two totals don't have to be exact.
That's right. They don't have to be exact, but you're going to get the maximum benefit by matching them exactly. And you know, we've had a great run in the market. It's an excellent time to consider this strategy and take advantage of harvesting if you can.
Absolutely. And what are some of the possible, I mean, when you're saying that it'll be tax-free completely, is that correct, if they were able to match these funds?
Right, because any gain that you would have paid is offset by any loss that you would have.
That's fantastic. So a really, really big one there. And for those who've had some major losses this year, maybe their gains don't equal their losses, what can they do?
Well, you can hang on to the losses. You can sell a portion of the investment to match what you have in gains, or you can sell more and carry it forward.
That's great. So just some different strategies there. Another one that you guys really recommend, and I love this one because it's a win-win, as you guys say, is donating to your favorite charity.
Right. A lot of people don't realize that you can actually take and appreciate an investment. So it has to have gone up in value. You have to own it for more than a year and a day. And you can donate that to your favorite charity, whether it's a church, a school, a hospital, a food bank. And you avoid any taxes by doing that.
That's great.
So typically you pay capital gains on any growth in your investment. By donating, you avoid all of that.
And the benefit here is, one, you get to provide your favorite charity with some money, but also the money that you would have probably put in, you can save and use that in another round of investing.
Right. You can turn around and invest what you would have paid to your charity and start the whole process over again. The charity gets the full value, so they don't have to pay tax on it.
That's great.
You don't have to pay tax on the gift, and if you're still itemizing your taxes, you can actually take it as a donation.
As a donation, wow! You can actually deduct that as well.
Right.
Wow, that's fantastic. So again, a win-win there for both the nonprofit or the charity as well as the taxpayer. So
right.
that's
Doesn't
huge.
get better than that.
Does not get better than that, for sure. One, you can save on your taxes, but two, you're also supporting good causes, which is a big thing, for sure.
Right.
That's great. And then the other thing is that tax rates currently right now are very, very low. The Fed is looking to possibly continue cutting tax rates, which is kind of historic at this point.
It is, but it's hard to say. You know, you want to take advantage of a historic low if you can.
Absolutely.
We don't know if taxes will go lower, and it's likely at some point they will go higher. So the benefit of taking advantage of those low taxes are, you know, you're always thinking, I'm going to avoid tax if possible. I want to reduce my taxes whenever possible. But let's say you're coming into the end of the year and you realize that you can earn maybe another $10,000 of income before you go into the next marginal tax bracket.
Okay.
Well, take that $10,000 that you could earn and make it happen. So that means take money from maybe a traditional IRA and convert it to a Roth IRA. That creates income. You take it, you're paying tax at a lower tax rate, and then your investment's going to grow tax-free because you just put it in a Roth IRA.
And that's the benefit of a Roth IRA is it's tax-free for life, which is a great thing.
Yes, and for life, it's even into the next generation.
Yeah,
which is really good.
If you did not take that investment out, and it carries over to your beneficiaries at that same zero tax rate as well.
Right, right. And you know, the benefit of a Roth IRA is you put the money in after it's taxed. It's growing tax deferred, but also with traditional retirement plans like an IRA, 401k, at 70 and a half, you have to start taking your money out. Not all at once, but a small distribution. In a Roth IRA, you don't have that required distribution.
You don't have that required distribution there. So that's a huge thing. So these are 3 huge tips to save some money and definitely get a little bit of a less of a tax burden next year, which is a big deal for anyone wanting to do that. Where can people go to learn more information about Smedley and also get your services?
They can visit us at smedleyfinancial.com, or they can call us at 801-355-8888. We'd love to sit down and talk about opportunities for them.
Excellent. Charla, thank you so much for coming
Thanks,
on Mountain
Diego.
Connections. We really appreciate it. Again, you can find out more about Smedley by going to their website, smedleyfinancial.com. We'll be right back with much more right here on Mountain Connections.